Hey everyone, this is Kirk here again from OptionAlpha.com, and in this video tutorial I want to talk about a covered call spread. So covered calls are for the long-term stock investor that is definitely looking for a steady or slightly rising stock price, at least for the term of the option. Now this is generally a capital intensive strategy because you have to be long at least 100 shares of stock to sell a traditional covered call. And really, this is where most people get started in making the transition between options and strategies and kind of moving away from trading stock just by itself and using some options and strategies in conjunction with stock. And I definitely agree that if you're going to be a stock trader and stock investor, you've got to have some sort of covered call strategy inside your portfolio because it's just the smart way of making trades. So let's talk about how you set up a covered call specifically. The first thing that you're going to do is you're going to be long 100 shares of stock, or you're going to buy 100 shares of stock. Now, in this case, you may already have 100 shares of stock. So in that case, you already kind of meet that requirement. But if you don't have those shares of stock, you do have to buy 100 shares of stock to do this strategy. Again, this is why it's a little bit capital intensive when you get started. Once you have those 100 shares of stock, you can sell one out of the money call against those positions or that position of stock. And basically the reason it's called a covered call is because that one option covers 100 shares of stock. So now your position is covered on both ends. So what's the risk? Well, because you are still long 100 shares of stock, your risk is still in the decline of the stock past your new break-even point as it heads lower. So selling the call option helps reduce the cost basis on the shares that you own. This is really the main benefit to doing a covered call strategy, and one that we've talked about a lot both in our blog and in our podcast, that it reduces the cost basis on the shares that you purchase and actually leaves you a little bit of wiggle room for the stock to move down and still make some money between now and expiration. And we'll show you a good example of that here in a little bit. As far as profit potential, covered calls do have a limited profit potential to the difference between the strike price and the stock price plus the credit received from selling that out of the money call. Now, although these are limited in profit potential, they make up for that in a higher chance of success overall on the trade. Again, because we're moving our break-even point lower and our cost basis on the trade lower, this gives us a greater probability of success overall going forward. Since we are short a naked option and the stock is not affected by volatility, increasing implied volatility generally does hurt this position. And what that means is that we want to try as much as we can to target this strategy when implied volatility is really, really high in the underlying stock that we're trading. And this gives us the best edge in the market. As far as time decay or theta, the passage of time as we generally get towards expiration does help this position since we are short premium that we received on the sale of the call. So the closer and closer we get to expiration, we ideally want to keep all of that premium that we received on the call option, and the closer we get to expiration, the faster this will materialize. As far as break-even points, they're very easy to calculate. You basically take the long stock price minus the credit received on the sale of the call. This is where we reduce the cost of owning the stock by selling a call again. Now, we're going to take a look at an example here using the stock ticker symbol USO. And USO is basically an exchange or an ETF that trades and tracks an oil fund for the US. And so again, that ticker symbol is USO. The stock's been really beaten down recently as of the time of this video. It's down around 1777 as far as a price. That's where it kind of closed today. So when we go in here to do our covered call, the first thing that we have to do is own the underlying shares of the stock. Now, in this case, we don't own the stock, so we're going to go ahead and buy the stock again at that price of 1777 where it closed today. And we're going to buy at least 100 shares of stock. Now, this creates a lot of capital requirement in our account because we have to cover that trade, but this is how we build that covered call. The next thing that we're going to do is we're going to try to sell an option that's out of the money. In this case, we're just going to go ahead and sell the next nearest option out of the money, which is the 18 calls above the market. Now for those calls, we should get about $1 for those once the market actually opens up tomorrow. So we're going to go ahead and place that order here for about $1. Again, it's about 2 pennies higher than where it closed today. So that 18 call then helps reduce the cost of owning the shares by $1, which is that credit that we received. Now, when we look at the payoff diagram here, you can see it looks just like the one that we had in the slides before. It's got this steep angle on the left side. This is basically where you own the stock. This is kind of your stock profit and loss curve. And then it flattens out here right at the strike price of 18. So you can see that strike price of 18, this is where it flattens out because you sold a call at 18. You are capping your profit beyond this point. You can't make any more money should the stock go higher. But now the benefit to doing that is you cap your upside potential in this trade, and you're capping it to about $110 in this trade, is that you move your break-even point down or lower from where it's at right now at $17.77. You move it down by a whole $1. So in this case, USO can actually fall another $1 and you still would be okay at expiration. You wouldn't make or lose any more money than you do right now. If USO fell less than $1, then you actually still make money at expiration. And if USO moves higher, you still make money at expiration. So this is why when trading covered calls, it's so important to realize that that reduction in cost basis, or the reduction in the cost of owning the shares, using that credit to offset that price, helps you in your increased probability of success. And most people don't get that concept, but it's so critical to your ability to do these long term. Now, one of the key takeaways that we have for covered calls is that you should always remember that if the stock should move past your out-of-the-money call strike at expiration, in our case with USO, it would be moving past that 18 call strike, you will forfeit your stock to the other party in the transaction. That's why it's called a covered call, because you are covering that trade with the shares that you already own. So in that case, the shares will be taken directly out of your account and you'd have to rebuy the shares at some price in the future. But again, that's okay if that happens, because that means that the stock made a huge move and you've already banked a profit anyway. You just didn't realize all of the profit from the stock moving higher. We personally don't favor these strategies because of the higher capital requirements. We think that there are other ways that you can get the very same profit loss diagram and the same risk reward features as doing a covered call, but with a lot less capital on the line. And so again, that's one of the ways that we use and teach options inside of our membership area at optionalpha.com. Even though this is a great strategy for long-term investors, we feel that there are better ways to make money trading this same profit loss diagram with much less capital. As always, I hope you guys enjoy these video tutorials. If you have any comments or questions, please add them right below here in the lesson page. And until next time, happy trading. Hey everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And in today's video, we want to talk about how you decide between doing a bullish trade in a debit spread or credit spread format. So if you've decided that you're bullish on some future direction of a stock or ETF, that's great. But should you choose to trade a debit spread or a credit spread? And often this is a question that I get so many times from our members and from students that I coach, is that they just don't know which way to go with a debit spread or with a credit spread. So in this video, we'll help you figure out which strategy is best for the current market, and it all starts by analyzing current IV rank or percentile. And as we always say, and as we definitely have in our downloadable PDF strategy guide, which you can find at optionalpha.com, is that it all starts with understanding where you think the market might go. In this case, we're already bullish, so that's good. The next step is to determine where implied volatility is, because volatility is our edge in the market trading options. So we want to have a good understanding of where implied volatility is. So I have two examples that we're going to go through here tonight on our thinkorswim platform. And the first example is EEM, and this is an emerging markets ETF. And so let's just say that for some reason you're directionally bullish on this stock. I mean, it did have a pretty good breakout today, and MACD and some of the other technical indicators are definitely pointing towards a higher move. So I agree that it could be a play for the bullish direction. It could be a move higher in the next couple weeks. But now the question is, do we do a debit spread or a credit spread? And in this case, we're going to choose to do a debit spread because implied volatility is very low. You can see that the IV percentile here, or the IV rank, is at 35. And that means that historically, going back over the last year, implied volatility is usually lower or usually higher than where it is right now. It's only lower about 35% of the time. And you can see here graphically this purple line on the chart. This is IV percentile. And you can see just going back here historically over the last year that a lot of times implied volatility has actually been much higher than it is right now. So we're actually getting into the market during a relatively low period in implied volatility. Now, as options traders, we want to target or focus our trades on the strategies that work for this market. So the two things that we know absolutely at this point is that the stock may go higher. I guess we don't know absolutely the stock's going to go higher, but we assume that the stock's going to go higher. And we know that implied volatility is low. So in this case, we want to choose a debit call spread, which would take advantage of the lower implied volatility market and the relatively cheap options that are out there. Now, the other trade that we want to go over today is XLU. So XLU is a utility ETF or utilities ETF for the spiders. So again, we're sticking with the ETFs here. And again, you can build the case for the fact that this stock has continued to move up all throughout the end of last year and the beginning of this year. And it may, kind of break out here from the 49.50 range that it's currently in. Again, same thing, the indicators are still showing that it could be continuing higher from here. So again, I get that the stock could move higher. The next question is, where's implied volatility? And we can see visually on the chart with our code here that implied volatility is in the 76th percentile. And so what that means is that 76% of the time over the last year, implied volatility has been lower than it is right now. And again, you can see visually on the chart, just kind of using this dot and going backwards in time here, that the vast majority of the time over the last year, implied volatility has been much lower than its current reading. And so as options traders, we can take advantage of this by selling options as part of a credit spread strategy. So in this case, we would sell a put credit spread below the market and take advantage of the rich implied volatility premium that's already in the market. And so that's one way that we can decide on which strategy we choose. So remember, when it comes down to picking whether you choose a debit spread or credit spread, it's all about analyzing current implied volatility in the market. If you guys have any questions or comments about this video, please ask them right below in the comment section for this lesson page. And until next time, happy trading. Hey everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And in today's video, we're going to go over the specifics of trading a call calendar spread. Now, a long call calendar spread profits from a slightly higher move up in the underlying stock inside of a given range. But they also profit from a rise in implied volatility and therefore are a great low-cost way of taking advantage of low implied volatility markets and options. Now, we often trade these when implied volatility has dropped, and sometimes they're really good in bullish markets. As stocks are slowly starting to rally higher, you want to trade either directionally spreads or trade some of these calendar spreads. So this is exactly how you set up this strategy. First, you're going to sell a front month out of the money call option. So this is the key point here. We're going to sell that front month out of the money call option. That front month option is going to be a little bit closer to where the market is trading. So days out is probably anywhere between 20 and maybe 35 days out. Then what you're going to do is you're going to buy a more expensive back month option. So the next monthly option that's out, an out of the money call spread at the exact same strike price. So we're going to be trading two different months, but pinning the exact same strike price. So what's the risk? your risk in these calendar spreads is limited to the width of the net debit paid for the spread. So if you paid a debit of $150 for your calendar, your risk is limited to just that $150. You can't lose any more money than that. Let's talk about profit potential. It can be very hard with these strategies because of the decay in the back month option that you're long to pinpoint an exact probability of profit. Ideally, what you're looking for, though, is to target your profit at the value of the sold front month contract. So if you sold the front month contract for $50 and you bought the back month contract for $150, you're looking to profit somewhere around $50 or that decay in the value of that front month contract. And again, profit is going to be maximized if the stock settles at the strike price at expiration. Because if that happens, then your short strike is completely going to expire worthless and you're going to be left with as much extrinsic value left in the long option for the back month as possible. So that's the ideal situation. That's where this profit and loss diagram kind of peaks, is right at your strike prices. Volatility, again, like we said, an increase in volatility will help this position because we're going to be net long options. We're going to have a longer term option in the back month, and compared to the negative impact on the front month option we're short, we're going to see a greater impact in volatility on the value of that back month option. So that's why volatility is really good for these positions. That's also why you want to trade them first when implied volatility is low. Because if you trade these positions when implied volatility is high, you're putting yourself at a disadvantage right off the bat, because an increase in volatility is going to help. And if implied volatility is already high, then you're really kind of stacking the deck against yourself. Time decay is definitely going to help this position, again, because we're looking to collect the value of that front month option that we sold. As an option seller, we like to see time decay and theta decay start to slowly eat away or erode that position much faster. So the closer we get to expiration, the faster that profit will start to materialize. With calendars, again, break-even points are so hard to calculate because there's no single calculation we can use. It's just important that you analyze the trade first before placing an order. So we will actually analyze a trade right here on our Thinkorswim platform. For this video tutorial, what we're going to do is we're going to use the SPY, which is the S&P 500 ETF. It's currently trading at just over 23, and we're going to do a calendar between March and April. So in this case, the March options, which have about 58 days to go or so, and we're just going to use a calendar, it's a little bit further out. I have about 58 days to go here, and those are going to be our front month contracts. Now, in most cases, we might actually look to do something a little bit closer, but for the purposes of this video, I wanted to do something that has a really good profit and loss diagram. The back month contracts in this case are going to be the April contracts, which are about 86 days out. So you can see the front month are March and the back month are going to be April. Now in this case, what we want to do is we want to start by selecting a strike price that's just a couple strikes out of the money. In this case, we'll go with the 205 strikes in both months. So we're going to target the 205 calls in both months. Now what we're going to do is we're going to first sell that front month contract. So we're going to go up here to the option chain and just click on the bid to sell that front month option at 205. At the exact same time, what we're going to do is also buy the 205 call for April. So now down below that creates our calendar spread, and you can see here below. This is our calendar spread, the April-March calendar. And the difference between buying the back month and selling the front month, which are these two prices right here, is our net debit that we pay on this trade of about 97 cents or $97. So in this case, the most that we can lose on this trade is $97. When we look at the profit and loss diagram, you can see that it's got the very familiar shape that we had in the video and the slides before. It's got that high peak that kind of rallies up to 205, and that's the point at which we make most of our money, and then from there it starts to slowly decline on either end. But the key here is, again, you don't lose any more than $97 regardless of where the stock goes. But this profit window for this calendar that we created is very large. In this case, we can make money all the way from 198 all the way up to about 212 on SPY. Now, SPY is currently trading about 203, so we're playing this again a little bit directionally bullish. That's why we're doing the call calendar. We'd ideally like to see the stock rally a little bit, but in this case, we also leave ourselves an opportunity to make some money even if the stock drops in value. So that's why these are slightly directional trades, but if you set them up correctly, you end up giving yourself an opportunity to make money in both directions of where the stock might move in the future. So some of the key takeaways for calendar spreads are, again, that they're low implied volatility strategies. They work best in markets that are low implied volatility that could see a rise in implied volatility, and using these strategies 1 to 2 levels out of the money with your strike prices in the direction that you want to trade. In the example we just went through with SPY, the stock was trading at about 203 and we traded the 205. So we were just about 2 strike prices out. You don't want to get any further than that, and you're going to play it very, very directionally, not going to take advantage of what a calendar really can do. Again, we always suggest closing the spread completely both months when you reach that front month expiration whenever possible. That should say whenever possible, not whoever possible. And so the reason that you're going to do that is because you want to maximize that time decay in the front month contract. Going back to the spread that we had traded in SPY, again, because we sold this option for about $3.95, that's ideally kind of the most that we would ever look to make on this trade. But in our case, we might look to take maybe about a doubling in our premium as far as a profit. So if we could increase our premium 100%, we would take that as far as a profit. So as always, I hope you guys enjoy these videos. If you have any comments or questions, please ask them right below in the lesson page. And until next time, happy trading.
Hello everyone, welcome to this weekly charting analysis, the first one for 2015. My name is Jasper Lawler, market analyst here at CMC Markets, and the webinar is going to be about half an hour, looking through some of the important charts, patterns and levels, alongside some of the fundamental drivers for the week in terms of the main asset classes that we trade here. Any kind of questions at all, feel free to send them through to the chat or Q&A boxes, and I'll get to them as soon as I can. So it's like I said, the first major trading week of the year. Some of you keener members out there might have been trading on Friday. It was obviously the first trading day, but really this is when it all kind of kicks into gear again. And it is a non-farm payrolls week for those of you who trade currencies especially, but also the US markets, and obviously it just affects all the global markets. We had quite a blowout in the last number, and subsequently had a pretty blowout US GDP number. So it's certainly going to be an interesting one. And by the by is that we have our non-farm payrolls webinar going this Friday, covering the whole event live. I'll mention a bit more details towards the end. The big one overnight, though, has not been so much not so much US oriented, but over here in Europe, those of you following the euro will have seen that it's crashed down below 120 and now hit 9-year lows right down around the 118 mark. It's pulled back a bit since. But just interesting to have a look at this chart, which I think has been referenced on the chart forum a few times here. But it's the 200-month SMA on the euro-US dollar and a rising trend line, both of which have been broken, which is quite significant because that's been holding up prices, like I said, for about 9 years now. So that's quite a big technical deal. So everyone's been talking about the prospect of quantitative easing from the ECB for a while. Also, there's just the weak European economy as reasons for a decline in euro, but to get through these levels is showing kind of an extra level of enthusiasm, if you like, for selling the euro. And obviously these Greek upcoming elections are not helping the issue. And so this is quite big. So where the market closes this week and then this month will be big. If it even if it closed around current levels, it would still be pretty significant. Be a definite technical breakdown. And we can see just on the shorter term chart, well, on the daily chart, we're in this kind of consolidation phase, but mid-November, we pretty much traded out of it, and then just these last few trading days, the last, over the weekend, it was Mario Draghi with the usual sort of jawboning of the currency and the prospect for quantitative easing that sent it lower. That alongside the latest failed Greek presidential election, which is leading through to a snap general election, which a lot of people are expecting to be won by sort of a disruptive, anti-austerity, anti-current EU-type measures party, which could result in Greece leaving or getting chucked out of even the Eurozone, which is obviously kind of disruptive. So so this is a fairly clear-cut trend right now, and it's it's way below these daily moving averages. And when you've got an accelerating trend like that, if you're trying to catch this wave, a bit late on at this point, but still, you want to ride the trend, and you've probably got to drop down to the shorter time frames. And already a couple of times the price has failed to even get back to 120, that key breakdown level. But nevertheless, we saw quite a strong reversal off the overnight lows. There's still a bit of a prospect for a bounce back, perhaps towards this MSMA, but you can see it's accelerated away a bit. Maybe that was the last kind of deceleration down, and you just saw it kind of steadily wound down until the next drop. So we could see another one of those. So if that is to be believed, then probably we're not even getting above these highs again, around 119.75. Should we get above those again, then that's when there's a bit more of an opportunity to perhaps sell at higher prices. A notable one would just be that former kind of consolidation area here, which is probably better. I've drawn a horizontal line and a declining trend line. I think that the declining trend line probably fits it the best, and so it'd be somewhere along those lines. I don't know. That's probably the best. Only a couple of touches, but you can see it kind of was broken, retested there. So should we get a move above here, then we could be looking up here, but really, obviously, the trend is down. Worth also, while we're looking at the euro, worth having a look at the Euro Swiss, because obviously the other big move that's happened in central banks happened late last year was the move by the Swiss National Bank to go to negative interest rates. So that's the kind of volatility that you can expect based on this kind of movement. I don't know if that it's probably not a greatest example for me to be showing you right now. That doesn't look quite right. Nevertheless, this was the move after the announcements of negative rates, and as you can see, it's moved the Euro Swiss right out of that kind of 120 handle that the Swiss National Bank have pegged against the Swiss franc. So that's one to keep an eye on, and the subsequent meetings from the S&B. Obviously, we don't have one just anytime soon, but certainly that's going to be interesting in relation to how likely it becomes that the ECB engage in QE, because that really, even though the Swiss National Bank kind of in a sort of side manner blamed the crisis in Russia for the increased currency flows into a safe country like Switzerland, really it's the euro getting sold off on the potential debasement that would come from QE that's their biggest threat. So the more QE becomes likely from the ECB, the Swiss National Bank may even have to engage in a similar program themselves, which they wouldn't be able to match in size, but the peg against a 120 is going to have to get more vigorously defended, and the negative rate's been enough for now, but whether it can keep going is a different question. What would be the fundamental drivers for the euro going forward? Well, on the 7th of December, which is Wednesday, we have the flash CPI, the first release of the Eurozone CPI, and there are some calls for that to go officially into deflation, which is obviously what's been trying to be avoided this whole time, and the ECB have been throughout have been saying that there is no risk of deflation, just prolonged low inflation, and that's enough for them to act. Well, now we're actually getting to genuine deflation, not on an annualized, not over the last year, but month to month. It's going to turn negative, which isn't, it's not a good thing, certainly. It damages confidence in businesses to be able to invest in the future if they think that the prices that they're eventually going to be able to sell for are coming down. Stable price is really ideal. Don't want runaway prices, but you certainly don't want really falling prices. Another sort of European event later in the week. There's a few industrial production numbers, but really, as per normal, it's the German one that counts. So that one will be worth watching. But really, it's in terms of trade in the euro, it's just all about the ECB, comments from the ECB members, and the fundamental data that's going to drive it, which i.e. inflation. And with oil prices acting the way they are, down another 3+% today, as you can see on the platform. Gamma's actually crushed. That affects inflation. It doesn't affect core inflation, which obviously strips out food and energy prices, but that's not actually how the ECB gauge their policy. So if we have a quick look at oil prices now, I've got WTI up on my screen, which I follow the most. But you can see this was the kind of the great white hope here, was that actually 55 could prove the level needed to hold up WTI, because you can see it just didn't actually. This is a 4-hour chart. Couldn't even get above the 55 period average on the 4-hour chart, and eventually it's just and it fell below, retested that line a couple of times, and the moving average, and we're dropping back again. And $50 oil is looking like an imminent prospect for WTI. So any pullbacks, we could look at just that form of consolidation area. And again, you've got to look at pretty short-term charts to kind of deal in this stuff. It's which one of these lows? Obviously, they don't quite correspond. This would be, down here, this level's already been. That's what we tested here. We're moving lower again, so that may be as good as we get. But higher price. This is obviously the better price that you're going to get. This is a more aggressive entry down here. Keep in mind this moving average, which has worked fairly consistently as a source of resistance. So if you're going off that, then it might be closer to this. By the time prices get up there, the average is probably going to be in that vicinity. And then chalk on a moving average. That looks around. Not probably 50. Well, let's have a look. I don't think it's quite 50%. It's probably maybe the 38. Yeah, it's in between the two. So that would be, an area for trading on a retracement. But obviously the momentum's down. So if you're trading on the break of lows, there should be a few opportunities coming up as we trend lower. Brent, that's just crossed below 55 for the first time today. Not the first time, obviously, but in terms of in terms of recent history. This is the larger chart I pull up every now and then, and do this line, and when we were back up it here, and literally just a couple of weeks later, we're actually looking at testing this trend line now. It's only had 2 prior tests, but this is a monthly chart, so it does have a good amount of significance to it. So that's where we're getting into now, and it does correspond with this sort of the consolidation area here, where we had a few spike lows, and then eventually broke lower from that. So if we're not to get to the lows at $35 a barrel, which obviously took place during a financial crisis, which, even though global demand is slowing right now, and obviously production is increasing, we're not in a financial crisis. So you wouldn't think we're getting to $35 a barrel, but it's certainly possible. The Saudi oil minister has said that they're absolutely fine increasing or maintaining their production levels at $20 per barrel. So they're the intentions within OPEC are to just let prices drop and flush out the US producers, run them out of business, and then maintain their market share, and eventually prices will correct itself. Peak oil will come back in, and we'll see higher prices again. But we've got an interesting level coming up, and that again kind of corresponds with the 55-ish and $50 in Brent, the global benchmark for oil. So we've got a bit currencies and commodities first. Well, since we are doing that, we're just going to touch on sterling. That also touched 17-month lows, I believe. And so you can see this is a weekly chart. So these are the kind of big levels to always obviously have in mind. You don't have to necessarily have them drawn in, but if you just check back to them every now and then, which is kind of what I was doing here. This was big, 3 touches back in 2012 and before, and that's where we're kind of pulling off a bit at the moment. But if we can't hold this, then obviously these are this is the obvious target. Would be this sort of, I'm using the first low here, but you could use the bottom, but it's certainly in that 148 type vicinity, with obviously the round number of 150 just above it. But again, the trend is very much downward. Some weak construction data today. That's not the be-all and end-all, but it is worth noting that just on that kind of housing side of things, the housing sector was a big driver of the recovery, and the pound was the reason for this big move higher in the pound was just because the UK was the best performing economy in the G7, and going great guns, outstripping growth in America up until recently. But the sort of political unrest associated with the Scottish referendum and the likes, and now the general election where the results are very much uncertain, and also what I was just about to get at was the house prices were soaring, and now they're coming off, and the housing sector was important to the UK recovery. One, in terms of the sort of wealth effect associated with just having a higher valued house and being able to revalue, readjust your mortgage to lower interest rates, gives you a bit more money in your pocket, and just the employment that it gave to estate agents and to the building trade was a big boost. So the house prices have been coming down for a few months. Mortgage applications have been down multiple months, and now construction, for at least 1 month has been turning lower. So that's a factor. Shorter term basis. So that's the long term level that I had drawn in there. But here's our kind of consolidation area that we were in. This was the low. You see, we kind of break down, touch again. It's a sideways consolidation. That's the low. We dip a bit below. These things are not perfect, but you can see generally what we're dealing with here is that downtrend. We move into a sideways consolidation, dip below it, retest. Now we just fall off a cliff. So if you benefit of hindsight, if you had to trade at the former low there, the bottom of the range, that's point perfect. Not point perfect, but it's all you need. And it's holding below that moving average, and it hasn't even got close to the 55-day. And you can see here, just as a note on the RSI, not got above the 50 for quite a while. Since basically the end of the uptrend. So that 4-hour RSI 50 level is proving quite a significant area of resistance. And it's one to keep an eye on if you are going to go long cable for the big reversal of this trend. You obviously can buy into falling prices, or you can wait for a bit of a confirmation, one of which would be a move above the 50 in the so I'm talking about 4 hours. It's the daily RSI. This daily RSI is obviously capped the prices. If a move back above the 50 in the daily RSI would be, to me, one of the signposts that the trend's reversing. But for now, it's very much down. And obviously, just a matter of picking your spots. This is going to be quite a big pullback at this point, back to here. Obviously, it's a fairly conservative entry. Not, your risk is above here or above there, but the move essentially has already happened, if you like. The opportunities have kind of been missed for this. So then we're waiting for the next sideways move for the next one, if indeed it does happen. Back over to commodities again, just one currencies and commodities. This is gold. Gold, it's kind of really the reason for the big rally was the potential for hyperinflation, people protecting their assets, financial crisis, people went to safety. Obviously, stock market's been booming for going on 6 years now, and there's really not much need for gold when all your other assets are doing so well. So gold prices have come down accordingly. But another correlation, not just one correlation with gold, is the stock market. The stock market goes up, gold tends to come down. The other correlation is gold with the Fed and ECB balance sheets. It was the Fed that really kicked off the fear of inflation that helped gold prices. But actually in the latter stages it was more related to the ECB, and there that we've posted charts, and I think Colin has quite recently, our analyst in Canada, a chart relating the ECB balance sheet to the price of gold, and there's a strong correlation there. So if the ECB, a lot of what's going to happen this year does rest on what the ECB does. So if the ECB do engage in some sovereign asset purchases, really expand their balance sheet, that's money being printed right there, and in a time of money printing, people will go to gold, or at least they have done in the past. So that goes some way to explain why we've got this 1800 level. We went crashing through it, went right down to, it doesn't look like it on this longer term chart in terms of some of the moves that we've had, but nevertheless was a $50, $80 move if you look on the shorter term charts. But we just didn't get that. We got into just above 130, and we pulled back way above 120, and we're back at this key 180 kind of level. So here you think, okay, it's been broken, but really you look at the longer term charts, it's not especially been broken. Here's the weekly chart and the monthly. Do we even get a close below there? We barely did, we did, but this is not the most solid break. This is really what we're talking about here, the kind of the flag on the monthly charts, and they're what count. And this candle was pretty disruptive to this being a big breakout. Certainly still could happen. If we're looking at sort of an A, B, C kind of correction, it's very simplified, or just a bear flag, bear pennant. You'd be looking at down here, sort of $800. I've done a video on this previously on projection for gold, and I think I had around 600 odd as a potential price target. Obviously, not banking on that at this point, but it's a pattern that's worth considering. But if the ECB engage in QE, my tendency to believe is that that's going to be supportive of gold, even though you would think that it's a more bullish case for the US dollar, and obviously that is a counterpoint. But gold against the euro certainly is going to improve, and I think even against the US dollar. So back over to equity markets. Just have a look at the UK 100. So here's the short-term level that we've just kind of broken through. But to give that a bit of context, this is really the line that I genuinely had it in, and that's what we've come off. It's not rocket science here. This was the sort of head and shoulders type double top that saw us fall right down to just short of the previous low, and that was a big level to break through. We'll come back, and that's what we'll come back off. And because this was such a big rally higher on this daily chart, there's barely a pullback to use as a sort of potential area of support. So on the daily chart, there wasn't much to go by. All you really had was the low that was formed there, this kind of high breakout area, and we've moved below that low as of today. So that's kind of a bearish development. Hit the EMA, boom, close right below it for the 4 hour. If we close below here for the day, it's a bit ominous, and I would say we're probably moving back to this head and shoulders type neckline that caused us to break higher in December. A couple of times now, it's like saying, if you want to see strength in the market, what do you look for? Taking out the highs. Rally, didn't take out the highs. Rally, didn't take out the highs. So each time we're making progressively lower highs here. And admittedly, the lows are not, it's kind of a higher low there, arguably, as well. Obviously, that's not. But it's a kind of bearish outlook, bearish sort of infused sideways market that we're looking at the moment. And if we treat this moving average as something significant, or any kind of trend line you want to do through there, we've had this rising kind of wedge type pattern, big breakdown, big rally and retest, big collapse, attempt to come back. So this 6100/6000 level is going to be huge if that breaks, because that all kind of foots into place as a kind of breakdown. But for the moment we're in sideways trading, but a breakthrough those to me is significant. Let's keep it in Europe for now. We've got the Germany 30. Similar looking thing. I think the 4 hours a bit more instructive. But again, this is kind of where we broke down. It's obviously looking a bit more positive in Germany, and this again relates to that good old story about the ECB. Germany's economy is certainly one of the stronger in Europe. Likely always will be. But it obviously saw a rough patch. It's kind of pulled back a little bit. It's still fighting deflation alongside the rest of Europe, but it's got record low unemployment. And you've got to believe, based off the economic data in Germany, there's not going to be much incentive for them to go along with a QE program, especially given their history of inflation in Germany. It's embedded in their minds not to do this kind of QE type program. So if it does go ahead, it looks like it's going to go ahead without the consent of the Germans, without consensus. But even though the German government and arguably the German economy could do without QE, the German markets are certainly looking for it, and that's why you're seeing the strength in the DAX. Last year, the DAX closed up 2% odd. The FTSE was down 3% odd. That relative performance is largely due to the upcoming QE in Europe versus the wind down and potential rate hike in the UK. So again, not taking out the highs recently here, but did previously. Did make all-time highs above 10,000 again. So more of a potential for just a little small back and jump back here. This was a very indecisive candle on Friday, but that's kind of choppy. Poor liquidity, holiday trading, so not much to be garnered from that. Really, probably back down to this chart and whether we can take out these lows, which you can see have been, when you see kind of 2 points like that right off the same area, you know that level is significant. Below there, that's the kind of breakout point. So be that one down towards these lows. If you're looking for correlation between the Germany 30 and the FTSE, you would argue that the Germany 30 is about to roll over, but still I would argue the trend is generally higher. The bias would be towards higher, and this is the bottom end of the zone for the current trading market in terms of this is the current price range. So if you're expecting prices to remain in this range, this is obviously the bottom end. If you're sideways trading, you buy in the bottom end, you sell in the top end. So just to finish off with US 30 and the SPX, just worth noting, I don't think this is necessarily going to play out, but there is, this is largely relating to the fact that we just had this such extended rally that prices did get very overbought. And now, obviously, this latest rally, which made a new high in prices, did not make a new high in RSI. So I'm you know, I'm not. I think it's probably not going to particularly play out. I mean, it has obviously already sparked a correction. I don't know if it's going to go much lower towards 17,430 would be the next level for me to be keeping my eye out on. If not, the moving average, but didn't hold on too well in the last correction. But what I think is a weak sign is that, okay, it didn't make up these previously overbought levels, but it didn't even get to 70 before rolling over, which is the generally accepted overbought level for RSI. So that's the negative, the bearish divergence alongside not getting into an overbought area before a pullback, to me is definitely some bearish signs. So if you see another kind of jump and then another rollover, that would be some extra confirmation, because then you would actually be literally getting the the failure to make a new price high as well as the RSI. Counter to that somewhat is you actually see a bit of on the shorter time frame. You see, I mean, this same exact kind of. I mean, I've just used two different charts to paint the same picture, really. But same kind of bearish divergence here on the daily chart. But worth noting on the 4-hour chart is actually quite a good little potential double bottom in RSI alongside falling prices. With quite a big with a kind of large wick candle there, which we haven't really got below since. So I think if we can maybe even just get below these levels here, 2055 or or 2062, that would be the kind of break point to confirm this little double bottom pattern here with the divergence. And obviously it's taking place alongside the 38.2. Should this little bullish pattern not play out, we are seeing a significant confluence of indicators here, the 61.8% retracement of the Fibonacci alongside this high from the 16th of December could make for an area of demand should prices drop again. So that only leaves me to quickly go over, running over a little bit here, but quickly to mention again that we do have the non-farm payrolls coming up on this Friday. We had a big number last time, big GDP result. Nevertheless, the expectations are for a significantly smaller number. 241k is the expectation, whereas last time we obviously had 321. So expected to be a bit of a slowdown for December. But a lot of that kind of relates to the kind of hiring that goes into the holiday season around Thanksgiving and around December, and then once you're actually in December, you don't need to hire anymore. So it's a bit of a seasonal thing. Overall, the picture's pretty good, but that if the number is below expectations, it will definitely kind of not pull the rug under, but remove a bit of the excitement that came in from that strong number last time and the strong US GDP. Okay, not seeing any questions here, so thanks a lot all for attending. And should you want to watch this again or pass it over to friends or colleagues, it will be available on YouTube later today, and we'll post that on Insights. Thanks a lot. Jasper signing off. Good luck trading.
Hey everyone, this is Kirk here again at optionalpha.com, where we show you how to make smarter trades. And today we've got an awesome video tutorial for you breaking down trading math, and specifically options trading math. It's basically a 101 course on why we have the methodologies that we do about the markets and about trading. So welcome back to statistics class, and you're probably thinking, oh, but don't worry. Undoubtedly more important than understanding the Black-Scholes model for pricing, which we purposely don't cover in any video tutorial that we have because it's pointless to cover. You don't need to know it to be successful. But besides that, your ability to understand just basic statistics and probabilities is paramount to your ability to be successful in this business. So if you don't get the math behind the trades, here's my promise to you. You will fail at trading options long term if you don't understand the math behind it, and more importantly, the statistics and the probabilities behind it. You can make a couple trades here and there and be successful, but to do this long term, to generate consistent monthly income long term, you've got to understand the math. So swallow your pride, head back to school with us as we talk in depth about standard deviations, probabilities, and statistics in this advanced tutorial. But before we do that, let's first have a talk about one real quick thing, and that's market efficiency. So this whole idea about market efficiency is really important, and you've probably heard us talk about in other videos that we have to trade liquid products and liquid underlying stocks. But this whole idea of market efficiency is this concept that the markets are super efficient, and especially in the US markets where there are millions and millions of different market participants, all with their own individual ideas. The markets are incredibly efficient and incredibly fast. Data or information that anybody receives on a stock or a company is immediately priced into the market. And as a guy who's been on both sides of the Chinese wall, basically I was a M&A analyst in New York for Deutsche Bank, and so I was on the private side dealing with mergers and acquisitions. And then I was on the other side of the Chinese wall in Tyson's in DC and dealing with the retail side as an analyst. So I've been on both sides of the wall, and I can definitely tell you the markets are incredibly efficient. There's no edge that you can get in knowing information about a company in advance or having some sort of insider knowledge. In most cases, most CEOs have no clue where their stock is going to go or how it's going to react to the market, regardless of how well they think they might be doing. So to that end, we have to understand that, as we said before, we have no clue where a stock is going to go, and nobody else does either, myself included. I have no idea where a stock is going to go in the future. I might have an assumption, an opinion, but at the end of the day, we're all no better than 50-50 on our guesses. So what this leads to then is to this probability distribution, and what we call a normal distribution, or what you probably have seen before as a bell curve. Now this is really important because this is how a efficient market distributes its returns. So basically what you have here is you have most of the returns are probably, somewhere around even or par, and that's basically what this kind of zero line here is. But it's saying that most of the time, the distribution of returns will be within a certain confidence range, or within about a 1 standard deviation. This is what this 1 standard deviation is that I'm kind of highlighting here on the chart. So this is saying that, okay, 34.1% of the time up and 34.1% of the time down, we might see this confidence within this given range. And we can define that range in stocks, in every particular stock that we look at. And we'll show that to you later on here. But you just have to understand that when a market has normal movements and an efficient movement, it's going to have a normal distribution of returns. Now, this means that most stocks are going to kind of land inside of that normal distribution. Sure, you're going to have the stocks that go outside of that distribution. So they make a 3 standard deviation move. So whatever most stocks are doing, they do 3 times that move. These are going to be stocks that are really high flyers, right? The 1 in a million stock that goes from $5 to $500 or whatever the case is. And then, of course, you're also going to have stocks that make a 1 or 3 standard deviation move to the downside. So these are going to be your stocks that go from $100 down to $10. It's the 1 in a million chance that the stock goes bankrupt or the company goes bankrupt, whatever the case is. Remember, this is a normal, efficient market. So most of the time, stocks are going to return some sort of normal average in the middle. And that bulk average here is what we're looking for when we start to place trades, just understanding that this is how a stock is distributed. Now, when we look at this same graph and kind of tilt it on its side here, we can see that this same concept applies to a stock distribution of its price movement over time. So I'll say that again. This same distribution will apply to a particular stock's price movement going forward in the future. So what I always like to do is I always like to say, okay, at certain points in the future, and let's just draw a line down here and say, okay, at this point in the future versus this point in the future, we can estimate, based on the entire trading history of the stock going back in time, how likely the stock is to rally or fall within a given range. Again, we can use the data from the stock going back all the way to its beginning, as much data as we have on that stock, to automatically and accurately calculate how far the stock is likely to move in a given range by a certain date. So in this case, if we're looking at this stock, which is just the S&P at some point in the future that we've taken this chart, then you can see that by the time that we reach this date or this line here, this expiration date, as the stock is trading, it might end up trading somewhere in this range. Okay, and that's likelihood. That's a good, likelihood of happening because the stock doesn't have that much time. And so based on its entire trading history, it's not likely to make a move all the way up here or all the way down here given such a short time period. So we know we can calculate that. As we go further out in time, the stock is likely to make more of a volatile move. So it's has more time here, and so you can see it can, widen out its breadth of movement. And again, that's true because as you can see going forward here on the S&P, the longer we went in time frame, the more the stock could move over time. And so that happens here too. And again, just continuing out into the future, you can see the stock can then really move as we start to go further and further out on the expiration cycle. So this same type of distribution can then be applied to where the stock moves over time. Now, most of the time, the stock is going to move within inside of this one standard deviation movement. And this one standard deviation movement is about 68% of the time. Now, we can exactly calculate this probability inside of most broker platforms. I'm going to show you how we do it at the end of this video. But again, just trust me that this one standard deviation move is about 68% of the time. And so it's really, really helpful to understand where a stock might move 68% of the time, because then we can build a strategy around that movement or take advantage of that possible movement. And this is how we get to high probability trading. Now, as we go forward, let's first do a quick review of volatility, because all of this normal distribution and stock distribution stuff has a hinge, and that hinge is a volatility and option pricing. So let's take two stocks in this example. Both stocks start out at the same price, which is $100. So in this case, stock A is the stock that's in black on this chart. And you can see it has very little volatility, which means that it moves more or less right around $100, give or take maybe $5 or $10 in the opposite direction. So it's moving very, very slowly around $100. It has low volatility. The frequency and the magnitude of its moves are very small. Compare that to stock B, which is going to be the stock that's in blue. You can see they both start out and end at the same price, but stock B has much higher and much more volatile moves in its price as it gets to that average of 100. So you can say that stock B, which is again the one here in the blue, has higher implied volatility than stock A. Again, stock A, which is the one here in black, lower implied volatility. Still the same stock, still around $100. It's just the level of movement or the frequency of movement that stock makes. Now, this drives us to our next topic, which is implied volatility. Now, implied volatility is basically an expectation of where the stock might move in the future. And depending on how volatile or not a stock is, that will cause option pricing to increase or decrease as a result to compensate for that implied volatility. So we take our normal distribution graph, which is really the one here in blue. This is that one from one of the other screens. So again, just a normal distribution or kind of average volatility in the market. You might see the stock have a range of between here and here, right? So the two extremes with, again, something around the median or the mean as far as its distribution going out into the future. Now, if implied volatility for that stock is a lot lower, so remember option A or stock A from the slide before, that black line that was kind of hovering around 100, if implied volatility is a lot lower, then that creates this distribution graph to get taller and skinnier, and that's this red graph here. And so you can see that it still has a normal distribution, but it's much more centered on the stock making very small movements out into the future. So instead of movements all the way out here, now the extreme movements, or the kind of 3 standard deviation moves, are much, much closer to the mean of the stock. Again, our standard deviations have moved in from a further out area. So the implied volatility in the stock is lower, and that means that the likely range of the stock going forward is going to be much smaller. It's not going to have the greatest magnitude of movement. Now, if we have a stock that has implied volatility that's extremely high, so it's making a lot of jagged and very quick moves, like that stock we looked at in this slide before, that blue line, it's all over the place, still centered around 100, but all over the place, then what that does is that slams down this distribution graph and it makes it much shorter and fatter. And so this distribution graph looks like this. It's much more distributed this way. It's a very flat, very wide graph. And you can see, because it's very volatile, the stock can rally really high. It can go that high, or it can go that low. Now, most of it's going to be around some sort of average or mean, but you'll notice that the average and mean has expanded. And now 68% of the time it trades within this range, which is all the way out towards the end of its shading. So 68% of the time in high implied volatility, the range of the stock is much lower. Compare this with 68% of the time when implied volatility is low, it's going to have a much shorter or narrow window to trade within. So you can see now that implied volatility is a critical ingredient to your ability to be successful, but it's also this understanding of how implied volatility shapes and molds this distribution graph that we use. So as implied volatility increases, or what's commonly called vega in option pricing, an option's price will increase as well to compensate for the higher probability of being in the money at expiration. Remember, as an option starts to make more as a stock starts to make more frequent moves, that option's price is going to increase, because now these options at the further extreme have an opportunity to be in the money at expiration. And the options down below also have a further chance of being in the money at expiration, because the stock is making huge moves in either direction. Now, this is why we specifically suggest that you sell options when implied volatility is high, because option pricing is going to be very much expensive and rich and swollen because of implied volatility. And this is also why we suggest that you buy options generally when implied volatility is low. And that's because option prices are generally going to be really low and have the propensity maybe to increase in the future. Now, with all of this hard data behind both volatility and possible ranges in the stock, we can actually build option strategies that target any probability of success we want. And this is really the key ingredient here, is that with options, you have the ability to target any possible win rate that you want. If you're trading stocks, your win rate is 50-50. You have a 50% chance the stock goes up. You have a 50% chance that the stock goes down. But with options, we have the awesome ability to target any probability of success that we want. So let's look at a really specific example here. This is a trade tab of SPY, which is the S&P 500 index. And currently SPY is trading right at 204.23. Now, in the next month, these are the February contracts. The next month out is February contracts, which are 29 days out. You can see that we are in a position right now where we're selling a spread or selling options above the market at the 208 strike price. So again, the stock is trading at 204, and we're trading options all the way out at 208. Based on all the trading history of SPY at this point and all of the volatility in SPY at this point, the probability of our option being in the money at expiration, again, using that distribution graph that we looked at a couple slides ago, the probability right now, hard numbers, that our option is in the money at expiration and loses is 29.35%. So the probability that a stock goes up to our level and closes above that level is 29.35%. So let's use that same probability and again go back to our stock distribution graph. And let's just say that the SPY, which is currently right about here, is trading at about 204 or 203, 204, right where it was in the slide before. Now, if our strike price is up here at 208, if this is the level that we don't want SPY to cross or breach, because we want SPY to close anywhere below this level for us to make money, then what we're saying here is with this distribution graph is that there's about a 30% chance that that happens. Now we, again, showed you where we got that number from and how we derived it. But there's a 30% chance that SPY from where it's at right now goes up to and closes beyond our strike price by expiration. Now if there's a 30% chance of this happening, that also means there's a 70% chance that it doesn't happen. And so a 70% chance that SPY never makes it up there and closes beyond that level at expiration. And this is where we get our very high probability of success trade. In this instance, the trade that we are actually truly in right now, and you can see this with the position markers, is a trade that has a 70% chance of success as it stands right now. Now, the beauty of options, like we said, is that you can pinpoint your chance of success at any level that you want. In this case, if you want a higher level of success, you can go out to these options, which are the 210 options. Those have about a 19% chance of being in the money or losing at expiration. That means if they have a 19% chance of losing at expiration, then they basically have about an 81% chance of being a winner at expiration. Now, of course, the market's going to compensate you and reduce a little bit of the money that you make because you have a little bit higher chance of success. So with these options that we sold those for $145 and we only have a 70% chance of success. And I say 70% chance of success like it's some lower number, but you know it's an extremely high probability versus going out to the 210 strike, which is over here. The 210 calls have about a 20% chance of losing, so an 80% chance of success. And you're only going to get $78.50 for that option. So again, you can see the markets are extremely efficient. They know that that further out option has a higher likelihood of winning, and therefore you're not going to make as much money. So there's definitely a sweet spot in there, but you can see you can pin your probability of success anywhere you want. Again, just to drive home the point again, we can go all the way out to the 212.5 calls, and you can see the probability of losing on those is 9.56, so about 10%, meaning that this is about a 90% chance of success trade. So it's really, really powerful how we can use these probabilities when trading to pinpoint our chance of success, and we cannot replicate this with stocks because stocks always have a 50-50 probability of success. So with all of this said and kind of wrapping up here, your only goal moving forward to be successful in trading options is to make as many small, high probability trades as you can on the right side of volatility. Period. End of story. That is the ultimate goal with trading, is to make as many small, very small positions so you don't take on too much risk, high probability trades like we just showed you that have a high likelihood or chance of success on the right side of volatility. Just understanding if implied volatility is low or relatively high so that you know if the market can expand in price or can contract in price. Remember that we want to sell options when implied volatility is high and we want to buy them when implied volatility is low. So I really hope you enjoyed this video. I know it was a more advanced tutorial, but we'll get into a lot more concepts as we get through this part of the course here. And as always, if you have any comments or questions, please ask them right below. Until next time, happy trading.